I've been asked to talk about the Wall Street perspective and sort of subtitle this coopetition versus competition. But I'm going to throw it through the lens of one of the things in my bio is I was in the senior management of a 17,000 person Wall Street firm. I ran investment banking, I ran equity capital markets, I was the CEO of all their .com businesses. It was actually a subsidiary of a 60,000 person organization. At one point I got all of the .com businesses reporting into me in the securities, insurance, asset management, real estate, and other areas. I think there were about 6 of them total. And so I think I've got a pretty fair idea of how major Wall Street firms look at risks, and we're going to talk a little bit about that. So here we go. Wall Street's big firms are very risk averse, and it shouldn't be surprising to folks because they have very large, very deep pockets, and if something blows up on them, it costs them a heck of a lot of money, more than it's worth. And they're also a kingmaker, meaning that the imprimatur of a JP Morgan or a Morgan Stanley or a Citigroup on a business as an investor can confer obvious advantages. They can bring business, so on and so forth, and they know that, and as a consequence, it tends to dictate strategies where they act as an investor. They will be a fast follower into a space, meaning that if you've got billions and billions and billions of customer assets that you advise, usually hundreds of billions, okay, you don't need to be the first mover, okay? You need to make sure that you've got moats around your business and you watch the technology, you watch other people make mistakes, take on regulatory risk, legal liability. And when you feel that it's properly vetted, you can either implement or buy. That's typically how the big firms approach these problems. So I went to online, you could do the same thing, and I pulled up Morgan Stanley's Code of Conduct, just as one example. And one of the fellows on my board of directors used to be in the strategic investment group at Morgan Stanley. And so we used to talk about something called their franchise committee. And they actually have calculated internally at Morgan Stanley, people have done this, what happens if I lose a penny in terms of aggregate loss to shareholder value? If I lose a penny in my share price, I lose, at today's prices, $17.5 million. If I lose $1 because of some whiff of scandal that goes through the marketplace and a stock sells off, I lose $1.75 billion of shareholder value. And so if you go online, you'll see that these are direct quotes. Does my action comply with the letter and spirit of applicable laws, regulations, and our policies? Well, I mean, if you look at the early ICOs, clearly the vast majority of them were clearly not complying with at least the spirit of the law, okay? Matters determined to pose potentially significant franchise risk. Again, franchise risk is the value of their company in the marketplace. That's how it's seen. Potentially significant franchise risk must be raised for review and approval by the appropriate franchise committee. Now, it was an interesting anecdote that a friend of mine relayed to me about an investment that Morgan Stanley had made in an African exchange. They had put about $30 million to work, and then one of the heads of state, it turned out, was actually engaged in graft. And if this came to the attention of Morgan Stanley's franchise committee, and they told him to sell their $30 million stake to the other investors in the company for $1. Just get out of it. Because the whiff of scandal and the potential for Morgan Stanley's name to get dragged through the mud was seen as so concerning that it was better off just to gift that $30 million stake to Africa. So when do you fully adopt? Well, big firm is going to look at it and they want to understand that it's been completely de-risked, that the legal framework is completely established. I think we're in the early throes of that happening. People are applying securities laws. They got to see that the technology is proven, that there is then adoption in the marketplace. Others have become the proverbial guinea pig, and that nothing has blown up. Others have been the proverbial penguin at the edge of the ice flow. One's jumped in, two's jumped in, three's jumped in, and guess what? No sharks are eating penguins. And that's how we look at it in this industry. There's also something driving in the background, which is the competitive threat reaches a tipping point, right? And you know, if I have 18,000 retail financial advisors, as some of these big firms do, I'm going to be concerned about token assets and crypto and being held outside of my firm, because I will start to lose. If those capital flows start to move into crypto and my firm doesn't accommodate crypto, at some point I'm going to see an erosion in assets under management, which is obviously going to threaten my core business. So at some point, that phenomena, if it gets large enough, is going to force me to have to shore up my flanks and to figure out what the solution is so that my customers, who now are dabbling or engaged in crypto, can hold their crypto assets, their securities as tokens, their tokens as securities, anything of that ilk within the confines of, be it Morgan Stanley, Wells Fargo, Bank of America, Merrill Lynch, UBS. I just named off some of the bigger retail houses in the country. You also have, you're going to reach a tipping point at which point certain institutional investors want to come into the market. Right now, I think that the major blockage is custody. And they can't take the risk that somehow their millions of dollars worth of crypto assets somehow go poof and can't be replaced. And so when we go back to the core foundation committee, I mean, these are clearly things that need to be checked off from a box standpoint before that tidal wave of bigger institutional assets come into the market. I mean, does anybody know what the aggregate market capitalization of the Nasdaq and the New York Stock Exchange is? Ballpark? It's over $30 trillion, okay? And so when we look at numbers like there were $13 billion worth of ICO or related issuance, it's really pretty trivial at this point. So the tsunami is where some portion of that $30 trillion in assets in public markets starts to come in and become ultimately tokenized. When some of that money, the real revolution, can get down to smaller innovative growth companies that drive innovation and job formation, can come down into smaller, earlier stage companies where the real sort of economic foundational growth and development occurs. Okay, and that's sort of the magic of this kind of a revolution, is availability of capital for worthy ideas that then in turn have profound social impact. I mean, we all know crossing the chasm been popularized, but what I would say is that, bringing it back to the original subtitle, we start with cooperation, we co-invest. That's what we do on Wall Street. If you go back, there's a great tradition of electronic communication networks, early ATSs, alternative trading systems. They were done sort of pass the hat rounds with major Wall Street firms, each taking a piece and driving some of their own volume through these stock markets that were being set up in the late 1990s to compete with the traditional stock exchanges. So, firms like Brute and Ready, if you remember some of those names, Datetech, I think, was one of them. You then sort of move into a more uncomfortable zone where there's coopetition. that we're starting to accept the technology more broadly at the larger firms, and we've now got to stake out how we're going to defend our flanks until finally it becomes absolutely seamless. It's fully adopted, and we're back to just beating each other's brains out trying to get the books on a deal, for the sake of argument. And that tends to be the adoption cycle. And I think that what I've tried to line up is that competition and full adoption, it's really at the late majority stage. This is a de-risked part of the market. The coopetition may be in the latter part of the early majority stage. And we're in the cooperation phase right now, which is really before it starts to cross the chasm. So I'm picking up on a couple of Aubrey's slides here that I wanted to focus on. What are securities tokens? I wanted to add to this is in terms of discussion. I mean, there has to be securities tokens that are fully SEC registered and meeting exchange listing requirements at some point. I mean, I've had the conversations with the guys that are running listings review at some of the major stock exchanges. If you looked at the Templum announcement recently, they actually got a CUSIP number, which is the single identifier for tokens as securities. And so all of these kind of traditional vestiges, check the box, that are actually required are starting to kind of come into place so that we can ultimately treat these things as being largely indistinguishable from traditional securities, at least from the standpoint of regulation. You are going to want to have a token that's listed that enjoys the preemption of state blue sky. And right now, there are only 2 national stock exchanges in the United States that confer that advantage. They're the New York Stock Exchange and Nasdaq, right? And the significance of that is that if you don't preempt state blue sky, then you have to register in each of the 50 states in order to allow folks to solicit trades. And what you find is that in this country, that most of the big firms, by policy, do not allow their brokers to solicit trades in the aftermarket, right? If those securities are not enjoying a national securities exchange exemption. Those securities have to be listed. And so, as we think through these issues, and I've seen from, I've heard from the people that are running listings that they've received, for example, securities that are convertible into underlying tokens, and I'm not sure that any of them have actually gone through and been approved at this point, but the significance of that is that there's for a listed company on a major exchange, there's a transfer agent requirement. Of course, the block may obviate the need for a transfer agent, but they're very, very slow on the regulatory side, very risk averse, very concerned about if we say that that's okay, then what are we giving up? And so we know that there's been discussions going on at the SEC to address exactly that problem, that concern. It's going to take some time, but I would expect it to happen. It's a little bit like manifest destiny. Why? Because look at the SEC chair. And I want to take a second to just tell you a little bit about SEC Chairman Jay Clayton. I met with him on the 18th of September in his office. I've known every SEC chair going back to Arthur Levitt. That includes Arthur. I met with Christopher Cox. He was a congressman, Harvard law educated, but didn't come from the deal business, if you will. Harvey Pitt, who had a reputation for really doing more work with the accounting firms broadly, and worked with Harvey on 9/11. He was actually very instrumental to getting the stock markets reopened when I was vice chairman at Nasdaq. I knew Mary Shapiro. Mary was the head of dispute resolution at the NASD, which then became FINRA. Worked for Bob Glauber. I was at Nasdaq when she was there. NASDAQ had NASD had a controlling stake in Nasdaq at the time, so we knew each other fairly well. Great public servant, Mary Jo White, who I adore. She was on the board of the major bracket Wall Street firm I was on for a period of time, and then Wick Simmons, who was the CEO of Nasdaq, brought her onto the board of Nasdaq. So I know her husband, John White, who headed the Division of Corporation Finance at the SEC, Mary Jo, as a public servant, has been in public service at least 3 times. She's the head of the litigation practice at Debevoise. She was the U.S. attorney that put the blind cleric into jail, a real patriot. But again, look at Jay Clayton. Jay comes from Sullivan Cromwell. He has done a bazillion deals. He's worked with equity capital markets professionals. When you walk into Jay's office and you talk about syndicate process and allocating institutional investors and how you actually bring an aftermarket order out of that allocation process, you know, he could run an equity syndicate department. Okay, I mean, he has a level of granular knowledge which we have never enjoyed at the SEC about capital formation. And so I think he's going to end up being, I hope, a very important leader at this particularly sensitive time. He says that there are 2 principles. This is in his Nashville speech, which is focused on capital formation. I call your attention to it because it tells you a lot about the leadership of the SEC right now. 2 key principles the SEC has followed for many decades. 1, to embrace new technologies that cut costs and provide new investment opportunities. Ding, ding, ding. Right? Is that not the securities token market? And continuing to require that our retail investors have access to material information necessary to make an investment decision, including the key risks involved, as well as other fundamental protections. This is exactly why most of the ICOs that were done early on in the process, you know, have created a lot of angst and an increasing flood of prosecution and sort of cleanup, because they did not respect investors in the sense of disclosure. There was not a lot of material information. If you went through early white papers, there were no risk factor sections. Okay? And so what I would urge everybody is don't get caught up in the weeds of trying to determine whether or not something is a security or not. There are basic fundamental principles at work here, and one of those principles is you have to respect the people that are investing in these securities. You have to give them an attractive deal. It has to be well thought out and articulated. You can't screw retail investors, and you have to disclose. And if you do those things, you're going to be in much better stead, and anybody that does it, frankly, deserves to be on the end of a subpoena. Anybody that doesn't. He also, in his speech, expressed concerns about improving capital formation in both public markets and private markets. And I'm going to tell you that getting more capital down into earlier stage companies broadly is an absolute national imperative in order for us to be able to compete globally. And this has been some of the core part of the work that I've done down in Washington, where we actually, if you go back to 2008, first documented that there's been a decline. There was an absolute collapse in the small IPO, defined as companies under $50 million in size. And then there was a collapse in the number of listed companies. We went from 9,000 publicly listed companies in this country down to 5,000. And meanwhile, other countries were growing in terms of their numbers of listed companies. And so this is the kind of thing that we have to fix as a nation. And it's so important to actually, you know, convince folks that, you know, that if you're making markets that create an ecosystem with adequate economic incentive for more people to get involved, to provide the value that's required to make markets and securities, to take them public, whether they're tokens of securities or plain old securities, that is actually a foundational element that's required to allow the next generation to thrive and prosper. I'm going to talk quickly about liquidity. This was, again, Aubrey's slide. Speed, efficiency, and liquidity. Liquidity is a little arcane. There's a lot of people that are running around saying, you know, if I tokenize things, that there's going to be spontaneous liquidity, okay? That it's going to create a valuation increase in its own right. It's absolute nonsense. Take it from somebody who, you know, worked as vice chairman of the Nasdaq stock market. And if you go down the market cap spectrum, there's a world of difference between large cap stocks and micro-cap stocks and nano-cap stocks. We'll talk about that in a second, but one thing it will do, particularly in private markets, is it's going to take a lot of the constipation and inertia and processing cost in private markets out of the system by automating such things as know your customer checks, Patriot Act compliance, which is largely focused on anti-money laundering and financing of terrorism, and all this, what Aubrey talked about, which was cross-jurisdictional compliance or interoperability, if you will. But what it's not going to help is what academics call asymmetrical order book tokens or securities. Most of this work's done in securities, where you've got a big seller and no buyer. And the typical condition is I've got $500,000 worth of tokens on something that's trading, maybe $5,000 worth of tokens a day. Okay, and let me tell you, that's not going to be liquid unless there are liquidity providers, and these are not ATSs. Those are trade facilitation platforms. It's not stock exchanges. Those are trade facilitation platforms. Those are people that are doing research, that have a view on the value, that then in turn have salespeople that can call customers and can create buy orders to offset sell orders at that point in time when it's required. It's still a people-intensive business, and that's the part of markets which has largely been collapsed out with this sort of maniacal focus on low-cost trading, which may work for innately liquid securities, sovereigns, so on and so forth, but it's an unmitigated disaster for micro-cap securities and tokens. So you're still going to need sales and distribution, you're still going to need research, you're still going to need an economic model to incentivize ecosystem investments, which are smaller middle market investment banks. Core foundations, very quickly. One of the things that I want to stress here is it's important to get right, but there's a major advocacy and educational process that I think is critical. People down in Washington, I think that the security token foundation industry is going to be able to lead. Aubrey is going to help us to be able to lead. I think it's one of the things that's a core competency of mine. But we're going to have to take lots of policymakers, be they at the SEC or down on Capitol Hill, and we're going to have to educate, and there's going to have to be a legislative agenda over time to make sure that we get this right. And so I would add to this list, traditional core foundations include public policy. You can't ignore that outreach aspect of it. And this was, I guess it was September 19th. This was a letter that I handed to the SEC chair when I saw him, which was entitled Fixing America's IPO Markets, Why This is Essential to U.S. National Interests and Jobs Act 4.0. And what we're talking about, there was just an act that was passed through Congress called, through the House of Representatives, called Jobs Act 3.0. It was a 32-piece sort of omnibus act. It passed the House 410-4. Overwhelmingly bipartisan. Where it goes, if it goes to the Senate, I don't know. But what we're going to start to talk about down on the Hill and frame is this notion of aftermarket and aftermarket liquidity, which is probably the, if you will, the blockage that we have to really unleash the next wave of innovation in this country and get more money down into the hands broadly of entrepreneurs, be it through security tokens or traditional securities. And so I hope all of you play a part in that. I appreciate the time, and I appreciate the amazing job and leadership that Aubrey's doing in kind of convening everybody and getting folks to focus, because I do believe that we're going to be much better off, and the end product is going to serve the country in terrific stead as a result of this leadership.